Do you know that global investments in artificial intelligence are expected to surpass $200 billion by 2026? But is this explosive growth a sign of innovation or a bubble waiting to burst? Hey, investors and future forward thinkers, welcome back to the channel. Today, we're diving into one of the most talked about and controversial subjects in the markets right now: artificial intelligence, or AI. If you've been watching the news, you know AI is everywhere, powering search engines, writing code, creating art, and even diagnosing diseases. The hype is real, but so are the risks. Now we'll break down what's really happening in the AI market, why some experts are warning of an impending bubble, and most importantly, how you can position yourself to profit, not panic, as this story unfolds. So grab a notebook, settle in, and let's get started. Let's start by addressing the elephant in the room. The AI market is sizzling hot. Companies like Nvidia, Alphabet, and Microsoft have seen their stock prices soar thanks to their leadership, or at least perceived leadership, in AI. Thanks to their leadership, or at least perceived leadership in AI, venture capital is pouring into AI startups at record rates. According to PitchBook, global AI funding hit $68 billion in 2023 alone, and that number is expected to triple in just a few years. But with every boom comes the risk of bust. Remember the dot-com bubble of the late 1990s and early 2000s? Back then, the internet was the next big thing, and investors rushed to pour money into any company with a .com in its name, regardless of fundamentals. We all know how that ended. Many fortunes were made, but even more were lost, almost overnight. Today, we are seeing similar warning signs in AI. Companies with little or no revenue are being valued in the billions. Startups are rebranding themselves as AI powered just to catch some of the hype. Insiders are cashing out quickly, and analysts are starting to raise red flags about overvaluation. The Wall Street Journal recently reported that some private AI companies are trading at price to sales ratios above 100, levels that are almost impossible to justify. This is classic bubble behavior. Excitement and FOMO push prices higher and higher until reality catches up. If you're an investor, you need to understand these risks. You need to know how to separate hype from substance and how to build a strategy that can weather the inevitable downturns. In the next session, we'll explore what's really driving this AI frenzy and how you can spot both the opportunities and the landmines. Let's recap what we've covered so far. The AI market is a double edged sword. On one hand, we have unprecedented technological innovation, billions of dollars in investments, and a tidal wave of enthusiasm across virtually every industry. But on the other hand, there are classic warning signs of a speculative bubble, soaring valuations, companies pivoting to AI as a buzzword, and insiders selling out while the hype is hot. If your goal is to profit, not panic, you need a blend of optimism and caution. Analyze fundamentals, prioritize real adoption, and always verify before you buy. Remember, in every bubble, some lose everything, but a well informed few come out on top. What's your take? Is AI the new .com or the next industrial revolution? Comment below with your thoughts and hit subscribe for more smart insights on investing and technology. Let's ground this conversation with some real world examples of how bubbles form, burst, and what we can learn from each. Think back to the dot-com crash. In 1999, companies like Pets.com, Webvan, and eToys were valued in the hundreds of millions, sometimes billions, despite little to no revenue. Investors got swept up in the excitement of a new digital era. When the bubble burst, trillions of dollars in market value evaporated, and many once hyped companies disappeared overnight. Yet, companies with real value, Amazon, Google, eBay, survived and went on to dominate their industries. The lesson? Hype is fleeting, but substance endures. We can early parallels in today's AI market. For example, some AI startups are securing massive funding rounds based on little more than prototype and few high-profile partnerships. Meanwhile, established giants like Nvidia and Microsoft are building real revenue streams from AI products and services. According to McKinsey, AI could contribute as much as 13 trillion to global economy by 2030, but only for companies that actually deliver value, not just promises. Let's look at a recent example. In 2023, C3.ai, a company specializing in enterprise AI software, saw its stock skyrocket on AI hype. But as earnings failed to meet expectations, prices tumbled, reminding us that inflated expectations can quickly turn into harsh reality. Contrast that with Nvidia, which continues to post record revenues from the sale of AI chips, powering everything from data centers to autonomous vehicles. Here's another. OpenAI's ChatGPT reached 100 million users in just 2 months, a record pace. But while user growth is impressive, monetization and long-term business models matter even more for investors. The companies that will win are those that convert attention and hype into sustainable, profitable business. Now, I want to bring you into the conversation. Drop a comment below. What's your biggest question or concern about investing in AI? Are you all in, cautiously optimistic, or sitting on the sidelines? I'll be answering all the top questions in a follow-up video, so don't miss out. Here's a quick poll for you. Type 1 if you think AI is in a bubble. Type 2 if you think it's just getting started. Or type 3 if you're not sure but want to learn more. Your participation helps guide the direction of this channel, and I'll always value your insights. While you're at it, share any AI stocks or companies you're watching. Let's crowdsource our research. The comment section is a great place for all of us to connect and learn together. So if you're serious about navigating the coming AI market bubble and positioning yourself to profit, here's a practical step-by-step checklist to guide your investment decisions. Grab your notebook or open a notes app because these are actionable points you can use right now. Start by asking, does this company have a real AI product or solution, or are they just using buzzwords? Dig into their white papers, product demos, and customer case studies. Do they have live deployments? Are their clients real? And do they have testimonials or published results? If you can't find evidence, that's a red flag. Don't be swayed by glossy presentations alone. Look at the company's financial health. Are they generating consistent revenue, especially from AI products? What's their R&D spend as a percentage of revenue? Are profits growing or are they burning through cash just to chase headlines? Companies like Nvidia and Alphabet have clear, peer-reviewed annual reports and strong fundamentals. Use online tools like Yahoo Finance, Morningstar, or your broker's research platform to analyze these numbers. Is the technology being used at scale? Are there major partnerships? For instance, when you see Microsoft integrating OpenAI's models into its suite of products, that's a sign of real adoption. Compare this to companies with only pilot projects or press releases. Substance beats speculation every time. Research the founders, board members, and executive team. Do they have a track record in AI or related industries? Are they serial entrepreneurs with a history of success or newcomers riding the trend? Monitor inside buying and selling. Are executives buying more shares or are they cashing out as prices rise? Have insider selling, even during hype, can be a warning sign that the team doesn't believe in the long-term value. Don't go all in on a single AI stock or sector. Diversify across industries and geographies. ETFs like Global X Robotics and Artificial Intelligence, BOTZ, or iShares Robotics and Artificial Intelligence, IRBO, offer exposure to a basket of companies. This way, you minimize the risk of a single company imploding. Always use stop loss and take profit orders. Decide in advance how much you're willing to lose or gain before you exit a position. Emotional investing leads to poor decisions. Discipline and automation keep you on track. The AI landscape changes fast. Subscribe to industry newsletters. Follow those leaders on LinkedIn and Twitter. And set Google alerts for major companies or tech breakthroughs. Regulation, for example, can change the game overnight, so stay agile. Schedule monthly or quarterly check-ins on your portfolio. Are your AI investments performing as expected? Has the competitive landscape shifted? Don't be afraid to rebalance. Sometimes the best move is to take profits and move on. No one has all the answers. Engage in investment forums, watch expert interviews, and ask questions. Commenting below is a great way to start. Let's build this knowledge together. Let's talk about risk. Every investment carries risk, but bubbles magnify it. Here are a few key principles. Never invest more than you can afford to lose. Keep a cash reserve for buying opportunities after corrections. Be wary of margin or leverage. It can multiply losses as quickly as gains. Separate your core, long-term holdings from speculative plays. Remember, sometimes the best move is to do nothing. Wait for clarity rather than chase every hype waves. If you follow this checklist and these risk management principles, you'll be far ahead of most retail investors. You'll have a system, not just hope, guiding your decisions. Let's take a moment to feature some stories from our community. Many of you have reached out, sharing both wins and lessons learned in the AI investing space. For example, Sarah, a regular commenter, shared that she jumped into an AI stock because of a viral TikTok video. It soared for a while, but when earnings missed expectations, the stock dropped 40%. Sarah admitted she didn't do her homework on fundamentals and learned the hard way about volatility in hype-driven markets. Her takeaway? Hype can make you money fast, but research and discipline keep you from losing it even faster. Then there's Michael, who took a diversified approach. He invested in an AI ETF, spread his risk across dozens of companies, and used stop-loss orders for protection. When a few of the stocks tanked, his portfolio held up because the winners outpaced the losers. Michael's discipline and risk management paid off, reminding us that slow and steady can really win the race. And let's not forget Lisa, who picked up shares of NVIDIA several years ago, not because of hype, but because she saw how AI was being integrated into real-world products, from gaming to healthcare. her patience paid off as NVIDIA's fundamentals and market leadership drove real, sustained gains. This as a story shows the power of focusing on substance over speculation. So, what can we learn from these stories? It all comes back to strategies we discussed earlier. Let's go deeper with some advanced moves for those wanting to maximize opportunities in this space. If you're an experienced investor, you might use options to hide your bets or generate income. For example, selling covered calls on volatile AI stocks can bring in extra cash while protecting against downside. But remember, options are complex. Never use them if you don't fully understand the risk. Don't overlook AI innovation outside the US. Companies in China, Israel, South Korea, and Europe are pushing boundaries in robotics, AI chips, and automation software. Diversifying globally can reduce country-specific risk and open up new growth frontiers for accredited investors. Private equity and venture capital funds can provide access to pre-IPO AI startups. These are high-risk, high-reward plays, so due diligence is critical. And these investments are only for those who can lock up capital for years and withstand potential losses. Track where institutional investors, tech giants, and even governments are putting their money. Major acquisitions like Microsoft's investment in OpenAI or Alphabet's purchase of DeepMind often signal real conviction and can point toward future winners. Keep an eye on regulations. Governments around the world are starting to craft AI-specific rules. Data privacy, security, and ethical AI are hot topics that could dramatically impact which companies thrive or falter. Sometimes the best investments are in the companies that enable compliance. Think cybersecurity, data management, or companies providing audit tools for AI systems. Stay plugged into investor communities, attend webinars, and read up on the latest white papers. AI is evolving fast, and those who keep learning will spot opportunities and risks before the crowd. Let's take a breath and recap everything we've learned today about the coming AI market bubble and how you can not only survive but thrive in this era of explosive innovation and risk. First, we saw that AI is more than a buzzword. It's a technological revolution impacting every industry, every portfolio, and every investor. There's no question that fortunes will be made, but as history teaches us, fortunes can be lost just as quickly when euphoria overtakes discipline. We dug into the signs of a bubble: sky-high valuations, companies pivoting to AI on paper but not in reality, insiders cashing out, and the media fanning the flames of hype. We learned from the dot-com crash that substance always beats speculation in the long run. We explored the real drivers on this market: breakthrough technologies, massive capital inflows, global adoption, and the very human emotions of hope and fear. We saw how companies like NVIDIA, Alphabet, and Microsoft are building real value, while others ride the wave with promises that may never materialize. You now have a practical checklist: 10 steps you can use to separate hype from substance. Analyze fundamentals, assess market adoption, check leadership, monitor insider activity, diversify, set boundaries, stay informed, review regularly, and learn from the community. This system makes you a proactive investor, not a passive gambler. We also talked about risk management because every bubble magnifies risk. Never invest more than you can afford to lose. Keep cash reserves. Avoid margin unless you fully understand the consequences. Separate your core holdings from your speculative plays. And remember, sometimes doing nothing is the best strategy of all. Real stories from our community, like Sarah, Michael, and Lisa, reminded us that discipline, research, and patience are the keys to long term success. We spotlighted advanced strategies, thematic ETFs, options and hedging, international exposure, even private markets for those ready and able. We stressed the importance of watching regulatory trends and staying plugged into the right communities for continuous learning. Above all, we recognized that AI is not just changing companies, it's changing the rules of investing. The winners will be those who adapt, learn, and act with both optimism and caution. So, what's next for you? Here's your challenge. Take one action this week based on what you've learned. Maybe it's researching an AI ETF, reviewing your portfolio for overexposed positions, or setting up a news alert for regulatory changes in AI. Maybe it's just joining a new online community or reading one deep dive white paper. Whatever it is, take that step. Momentum is built one action at a time. Before you go, make sure to subscribe and turn on notifications. This channel is your home for smart investing strategies, market deep dives, and the latest tech trends. We've got more videos coming up, like my full breakdown on blockchain's impact on global finance and a panel discussion with AI industry insiders. You don't want to miss it. Thanks for spending this time with me. Remember, smart investing isn't about avoiding risk, but understanding it and using knowledge as your edge. Stay disciplined, stay curious,